This is PMO Consultancy. I'm Nick. This is Calvin. This is the second episode of our stock market series on teaching you how to choose a company to invest in the stock market. Today, we are analyzing financial statements, and we're going to be covering three of them. We're going to first be covering an income statement, then a balance sheet, and lastly, a cash flow forecast. Now I'm going to be passing it on to Calvin.
So, the analyzing financial statements is one of the most critical steps in fundamental analysis. It helps you assess a company's financial health, profitability, debt levels, and cash flow sustainability. These are the three main ones we're going to analyze today. Statement. We'll be starting with the income statement overview. We'll show you a picture later of all three statements. There's just no space to fit it in here. So the purpose of an income statement. The income statement shows a company's revenue, expenses, and profit over a period. It can be either quarterly or annually. Now, this only applies to publicly held companies because privately held companies don't need to disclose this information to the public because they don't have investors for the public. And it helps determine how efficiently a company generates profits. Importance. This statement provides crucial insights into a company's profitability and revenue growth patterns over time, which is what we want to see the most, long-term growth. Now, these are some of the key income statement metrics. First of all is revenue. It's called the top line. The revenue is what it implies, the total sales or income a company generates. Growing revenue indicates a business expansion. Like, for example, not an example, but last video we talked about how the different revenue streams that a company has. So all of that should be accumulated to one revenue in this statement, and you can see that. Next is costs of goods sold. Now, this is the direct cost of producing goods and services. Lower cost of goods improves profitability, like we'll show later in the profitability ratios. Basically, you take revenue, you minus it by cost of goods sold, and you get gross profit, which is, what it implies. Here, gross profit margin, it says here, is gross profit divided by revenue times 100. It's a rate, so it shows how much profit remains after production costs. Next one is operating profit margin. Now you get the operating income, which is here, and then you divide it by revenue, and then times it by 100, which measures profitability after operating expenses. This is basically the ratio of profitability after minusing all the costs, direct and expenses, indirect costs. And then there's net income. This is the bottom line. This is the final profit after deducting all expenses. So step 1, deducted all direct costs. Step 2, all the expenses deducted, and taxes and interest. So if you deduct all of that, you can see the final profit of a company in a period, normally like a quarter. And then earnings per share, which is found by net income divided by total shares. Now this helps compare the profitability on a per share basis. So what this means is, for every share that they have, how much earnings does a company generate for it? The higher the better, of course.
Now we're moving on to balance sheets, also known as a company's statement of financial position. So basically, this sheet provides a snapshot of a company's financial position, as in the name. At a specific point in time, it lists the different assets, liabilities, and shareholders' equity, helping determine a company's financial stability. As stated, it is important in helping investors understand a company's financial leverage and just overall stability. So these are some key metrics that us as investors want to look at. A company's total assets, so that's just everything they own, including cash. It could be anything like property or just inventory, such as machinery. Higher assets just means strong financial backing, just means they have a lot of money. Total liabilities is just everything a company owes. That could be debts or just loans from the bank. High debt can be risky if earnings are unstable, as these companies have to pay back these liabilities. A debt to equity ratio shows the total debt divided by shareholders' equity. So this measures how a company is financed by debt versus equity. A lower ratio is preferred, as that means that equity is high or debt is low relative to each other. A current ratio is current assets divided by current liabilities. This just essentially measures how if a company is able to pay back all their debts. So a ratio above 1 means that they are able to cover their short-term debts. Ideally, a company would want to be around 1 to 1.5, as anything higher would just mean that the company has too much cash. As cash depreciates, companies do not want to hold as much cash as it loses value. That's why a range of 1 to 1.5 is ideal. Lastly, the book value per share. This is total equity divided by total shares. It helps evaluate whether a stock is undervalued or overvalued. If the book value per share shows that the company is undervalued, this might be a reason why us as investors want to invest in the company. Now we're moving on to a cash flow statement. So the purpose of the cash flow statement, it tracks just how much cash is coming in, cash inflows, and how much cash is going out, which is cash outflows. So unlike profit, it just shows the real liquidity, essentially how much cash is available for companies' operations, investments, and to pay off their dividends. It is important as it reveals the actual cash position of a company, which can differ significantly from reported profits. So these are some key metrics that we want to look at. First is the operating cash flow, also known as OCF. Is the cash generated from daily operations, so selling their goods, a company selling their goods. A positive OCF score means that the company is getting real cash, meaning that they are earning profit in the form of cash rather than credit. Number 2, free cash flow, FCF. You get this by operating cash flow subtracted by capital expenditures. This indicates just how much cash a company has available for expansion, dividends, or stock buybacks. Now, third, investing cash flow. It tracks the money spent on investments like new machinery, new equipment, or just new acquisitions such as other companies. Lastly, financing cash flow. It shows the cash movements from issuing or repaying debt, issuing stock, or paying dividends. And now these are all of the different financial statements that we looked at today. This is a cash flow statement, this is a balance sheet, and this is a statement of profit and loss.
Yeah, so as Nick said, this is the example of all 3 financial statements that can be found on a company's website. For this one, this is a Amazon Q4 report that they published on February 6th of 2025. And here you can see the cash flow statement from the months of, I can't even see. From this period here, you can see the date until here. And you can see it's a really complex sheet, but then we will be talking about it in later videos. Also, this is the balance sheet. You can kind of see, I don't know if you can see, but liabilities here, current assets here, long-term liabilities, and then you have retained earnings here. And this is the income statement, where cost of sales, and then you minus all that stuff, and then you come to here where you get can't even see it. Yeah, anyway, we'll in the next video we'll be using the fundamental analysis that we talked about in the last video, and also the 3 financial statements to give you an example, choosing a company, and then going step by step with you guys how to